the Fed's big move to start scaling back stimulus means for the U.S. and for emerging markets. We're joined by Keith Fitz-Gerald, Chief Investment Strategist for Money Map Press and Chairman of the Fitz-Gerald Group. Keith, thanks so much for joining us tonight.
Thank you. It's good to be here.
So, Keith, Ben Bernanke, Fed Chairman, said that from January, the Fed will reduce its spending on U.S. government bonds by $10 billion a month. Investors around the world largely unfazed by the Fed's decision, as we reported earlier, to reduce its monetary stimulus. Why did we see a relatively muted reaction in the global markets?
Well, I think there's three reasons. Bernanke made it very clear that he's looking at underlying economic data. Now, whether those calculations are flawed or long-term remains to be seen, but it was not a withdrawal of stimulus, which is what everybody's fear was. So what you're seeing really is a classic trader's reaction, a reassessment of risk, a gradual move to find out what the new boundaries are going to be. And I think it's going to play out over the next week or so, and then the markets are going to return to their concentration on economic data rather than a short-term technical move.
Well, you mentioned economic data, and what do you make of the Fed timing? I mean, the Fed indicated that the economy is stable, but then just today we got some concerning data points. Existing home sales fell to their lowest level in nearly a year, and then new claims for jobless benefits climbed last week to a near 9-month high. Given today's data points, is it too soon to taper?
Well, I thought Bernanke was incorrect to begin this entire QE process because, any company can exist with federal stimulus into infinity. You never go broke on accrual accounting. I think he's too early. I think he's off the mark, and I think he's looking at flawed data. I remain very concerned that the American middle class does not have the spending power to deal with this, and I think that's why he left the door open to additional stimulus, and we may yet see that out of Janet Yellen by mid-2014.
So you think it's too early, and you think the Fed may then change pace if the data doesn't support this decision? You think they'll come back with a stimulus?
Well, I do. As incredible as that seems, I watched Bernanke's language very carefully. He left that door open. He said we are not on any preset course of action. You'll notice that he also spoke very carefully about leaving interest rates low. So I think he remains plenty concerned. I think he did it because he was under incredible diplomatic and political pressure to go ahead and begin the taper so he does not shock the global community come mid-2014 when everybody does get back to that economic data. So I do think this was very deliberate.
Well, that's an interesting point, Keith, and I'm glad you mentioned the interest rates because that does seem to be everybody's saving grace here, especially with regards to emerging markets. How significant is it to emerging markets and global markets that the Fed said we're going to keep interest rates low for now?
To me, it's very significant, and the reason is, as your prior guest pointed out, there's a lot of money that came into international markets because U.S. rates were so low. What remains to be seen is that will that money return to the United States if rates rates rise? I don't think that's the case. I think there's enough stability in areas like China and Japan right now that it's going to be very good. What I'm worried about is markets like Indonesia. I'm worried about Brazil. I'm worried about South Africa. I'm worried about Jakarta, where they don't have the reserves or the capacity to absorb such a rate change when it occurs.
Well, let's talk a little bit about China first. Now, China has some of its own liquidity issues. You think China will still be able to weather this in its stride, though?
I do. I actually have great confidence in China. China has a very long-term perspective. They have a solid economic machine. But, don't forget, America had its adjustment period, too, in the 1920s and 30s and even 40s. We struggled in this country with interest rates and liquidity, many of the same issues that China is faced with now. Ultimately, the growth that's pent up in China's middle class, I believe, is going to overwhelm that, and I believe China is off to a good start. So, to me, this remains China's century, and I think China knows these problems well, and they're going to work their way through it.
Well, Brazil and India, you mentioned Indonesia. Brazil and India said that they had taken some precautions to prepare for this. I mean, this didn't come as a big surprise because the Fed has been warning about this for ages. So how have these countries sort of priced this in? How did they stand in terms of resilience to weather this?
Well, I think they maneuvered their national industries in such a way that they're going to be GDP sensitive. And what I mean by that is that they were not exposed to the change in currency value vis-a-vis the dollar or their native currency. And I think that gives them strength. I think they were cautious to build up their reserves. And I think that they've been gradually raising rates. So there was an attractiveness built into their currency prior to Bernanke's actions. I hope that they can continue that because I do believe long-term in the viability of both of those economies.
Okay. We'll see how it all pans out in 2014. We'll have to have you back then. Thanks so much, Keith Fitz-Gerald, Chief Investment Strategist for Money Map Press and Chairman of the Fitz-Gerald Group. We'll stay